All right, let's get one thing straight, folks. When you're trying to figure out what the Federal Reserve is going to do next, you can't just look at the same old numbers everyone else is yapping about. No, you gotta look at what they look at, and that, my friends, is the core personal consumption expenditures price index, or PCE. This isn't your grandma's CPI. The CPI is a fine number, a nice little appetizer, but the PCE is the main course. It's what Jerome Powell and his crew are chewing on when they decide whether to raise, hold, cut interest rates. Booyah! So why is PCE the big kahuna? It's simple. The PCE index is broader and more dynamic than the consumer price index. It accounts for how people change their spending habits when prices shift. If steak gets too expensive, you buy chicken, right? The PCE captures that substitution, giving a more realistic picture of what inflation is actually costing people. The core part is even more crucial because it strips out the wild, crazy up and down prices of food, energy. The Fed wants the real underlying trend, not the noise. They want to know if inflation is truly baked into the cake. To understand where we're going, you have to know where we've been. And this summer has been a real roller coaster, a battle between hope and reality. Let's rewind to the May 2025 PCE report, which came out in late June. The market was feeling pretty good, thinking inflation was yesterday's news. But then, bam, the number came in a little hotter than expected. It wasn't a disaster, but it was enough to spook investors. The dollar flexed its muscles, stocks took a little haircut, and the bond vigilantes came out of hiding, pushing yields higher. It was a clear message, don't get ahead of yourselves. Then came the June numbers released at the end of July, and this time the print was more or less in line with what the economists had penciled in. The market breathed a collective sigh of relief. It wasn't great, but it wasn't a catastrophe either. July's PCE report, which we got last month in August, was the one that really threw a wrench in the works. Everyone was braced for another lukewarm number, but it came in surprisingly cool, and the market went absolutely bonkers. That's why this upcoming August number is so critical. The stakes couldn't be higher. You can't just look at one number in a vacuum. You gotta be a detective. Connect the dots from all the other clues. Lately, those clues have been sending seriously mixed signals. Let's start with the consumer price index, the CPI. Headline inflation ticked up a bit because of rising gas prices, which fuels headlines. Core CPI, the more important read, showed continued moderation, not collapsing, but grinding lower. Next, the producer price index, PPI. Think of it as the pipeline for inflation. What businesses pay today often becomes consumer prices tomorrow. Recent PPI has been all over the map. Some components are cooling, others, especially services, remain stubbornly sticky. Dig deeper, ISM reports, ISM manufacturing, check prices paid, ISM services, check prices paid. Prices paid is a real-time signal from purchasing managers. Manufacturing prices have been pretty tame. Services prices paid are still elevated. Finally, the outside world, import prices, export prices, trade frictions, and uneven global growth make these volatile. A stronger dollar can push import prices down, but it can also hurt our exporters. The data mosaic is complex. Some pieces green, others flashing red. Markets are tense, coiled like a spring, waiting for the PCE to pick a direction. So the big day arrives, the number flashes across the screen. What do? First rule, don't panic. The initial reaction is almost always driven by algorithms and knee-jerk traders. It's pure chaos. My advice, let the dust settle. Wait 15 minutes, scenario 1. The core PCE number comes in hotter than expected, 0.3%, 0.4%. This is the nightmare scenario for the bulls. It means inflation is re-accelerating. In this world, the US dollar is king. Scenario 2. The number comes in cool 0.1% flat. This is the pay dirt the market has been dreaming of. It confirms the July trend and gives the Fed the green light to start talking about a pivot. This is the risk on signal. EUR, USD rallies, GBP, USD rallies. The Australian dollar will fly. Stocks will rip higher. It's a party and everyone's invited. Ultimately, this PCE release is more than just another data point. It's a potential turning point. For traders, the key is risk management. Know your entry, know your exit, use stop losses. There's money to be made here, but you have to be ready to pull the trigger. Booyah.